Welcome back to the Pro Ticker Podcast, everyone. Your Friday morning edition covering major financial magazine
It's
headlines.
been another wild week.
It really has, hasn't it?
Just a fire hose of information, as always.
Yeah, so we thought for our deep dive today, we'd cut through the noise a little bit, you know?
Give you the need to know,
Exactly. Get you up to speed fast.
like an espresso shot of financial news.
I like that. So we've been sifting through the top financial magazines, Bloomberg, the Wall Street Journal, Market Watch, all the heavy hitters.
The ones you see on those fancy newsstands, the ones with the really thick magazines.
Exactly. And we're bringing you the insights that really matter, the so what behind the headlines, just for you.
It's kind of like we're doing the hard work of reading and analyzing so you don't have to.
Yeah, we summarize and synthesize it all and make it, hopefully fun and engaging along the way.
That's the goal, at least.
Definitely. So today we've got a pretty interesting mix. We're going to try to make sense of a surprise move in the European bond market.
Always fun.
Oh, yeah, then we'll unpack a massive tech acquisition and what it could mean for, the broader tech landscape.
Billions of dollars flying around.
Oh, yeah, definitely. Billions with a B.
We'll also try to get a read on the U.S. economy.
Right through the lens of a major logistics player. So that should be interesting.
A real-world pulse check.
Exactly. Then we'll find out why market strategists are suddenly so bullish on Europe.
A bit of a contrarian view there.
Yeah, for sure. And we'll jump into the world of AI chips, which is absolutely booming right now.
Can't open a magazine without seeing AI these days.
So true. And we'll take a look at a retail giant's turnaround strategy, plus some optimistic takes on where the stock market might be headed.
A little bit of hope for the bulls out there.
Gotta have that. And of course, no deep dive would be complete without a touch of crypto.
It wouldn't, would it?
Nope. Solana ETFs are making a splash, and MicroStrategy's got some, let's just say, interesting Bitcoin plans.
Oh yeah, Michael Saylor never disappoints in that department.
Never a dull moment. So are you ready to jump in?
Let's do it.
All right, let's start our deep dive over in Europe with a headline that might sound a bit well technical, but trust me, it's got some interesting implications.
I'm intrigued.
Bloomberg ran an article titled Deutsche Bank decides against calling one of its AT1s bonds.
AT1 bonds. Now, those aren't exactly, dinner table conversation for most people.
Not usually, no, but think of it this way. It's kind of like if you had the chance to refinance your mortgage at a lower rate but decided not to.
Okay, I'm listening.
It might seem strange at first glance, but there could be some interesting reasons behind it, right?
Right, so what's the story with Deutsche Bank and these AT1 bonds?
So Deutsche Bank has decided not to redeem a $1.25 billion bond that has an interest rate of 4.789%. And normally, European banks would jump at the chance to buy back these types of bonds, especially when rates are higher.
So why are these AT1 bonds so special, and why is everyone so focused on whether they get called or not?
Well, these AT1 bonds, they're a special kind of debt that banks issue. They pay a bit more interest than regular bonds.
Okay, higher yield always catches an investor's eye.
For sure, but there's a catch. They also have these features that allow the bank to absorb losses if things go south.
Ah, so they're riskier than your typical bond.
Exactly. And usually, European banks, they like to call these bonds back early, buy them back. It makes them look good to investors, and it helps manage their borrowing costs. But Deutsche Bank is breaking with tradition here.
Interesting. So why are they doing that?
Well, according to the Bloomberg article, they're taking a, quote, case-by-case approach, end quote.
Vague but intriguing.
Right. So this brings up something called extension risk for investors, and that's something you really need to understand.
Okay, extension risk, break it down for me.
Basically, it means that the bond's maturity could get pushed further out if Deutsche Bank chooses not to call it back. You see, these AT1 bonds, they're perpetual. They don't have a fixed end date.
Perpetual, so they could theoretically just go on forever?
In theory, yes, but the market was assuming they'd get called early. This decision from Deutsche Bank throws a wrench into that assumption.
Ah, so now investors are a bit unsure about how long their money might be tied up.
Exactly. It adds a layer of uncertainty to the whole thing.
Makes sense. Bloomberg even quotes this guy, Jose Mosquera from Row Investments. He says, quote, DB has always been at the more pragmatic and less investor-friendly end of the spectrum. It should be very clear to investors that calls should be purely based on economic feasibility, end quote.
Ouch, sounds like some feathers were ruffled.
Yeah, a bit of a wake-up call for some investors who might have thought these calls were more of a formality than an actual economic decision.
Absolutely. These AT1 bonds have been popular because of those higher yields, and European banks have been raking in profits lately thanks to those higher interest rates. But this move by Deutsche Bank, it throws a bit of cold water on things.
Reminds everyone that these aren't your guaranteed short-term high-yield plays.
Exactly. As an investor, you got to consider the possibility that the bond could be outstanding for a while longer, and that impacts your returns and how easily you can sell it if you need to.
The liquidity of the investment, as they say.
Precisely. But here's the thing, and this is important. Deutsche Bank is actually going to redeem a separate $1.5 billion AT1 bond in April, but this one has a much higher interest rate, 7.5%.
So they're not saying no to all AT1 calls, just being selective.
Exactly. It really emphasizes that case-by-case approach. They're clearly weighing the cost of those interest payments against their own needs and what's happening in the market.
It's all about finding that sweet spot.
Right. And Bloomberg also points out that earlier this year, sales of AT1s were through the roof. Banks were taking advantage of those tight spreads, meaning it was cheap for them to borrow money by issuing new debt.
Ah, but now Deutsche Bank's decision might make investors think twice about those future AT1 issuances.
Exactly. A little more caution in the air.
Makes sense. Okay, so we've gone from the depths of European bank debt
To,
Let's switch gears completely, shall we?
Yeah, let's talk tech.
Much more exciting.
The Wall Street Journal had this exclusive headline that just screams big money.
Oh, I love those.
Exclusive. Google's cybersecurity deal spins tiny investment into $4 billion windfall.
Now that's a headline.
It's a doozy, isn't it? And it really highlights just how explosive those early-stage investments can be, but also how risky.
High risk, high reward, the venture capital motto.
Exactly. So Google's buying this cybersecurity startup Wiz for a whopping $32 billion.
That's a lot of zeros.
It is, and it's not just about the price tag. It's a prime example of how a small, early investment can turn into an absolute fortune.
The kind of story that makes VCs drool.
The Wall Street Journal focuses on this one early backer, Index Ventures, and the massive payoff they're getting.
Okay, so how much did they put in initially?
Just $3.5 million in seed funding. That's it.
$3.5 million for a company now worth $32 billion. That's got to be some kind of record.
Well, they invested more over time. Their total investment ended up being $245 billion.
Still a drop in the bucket compared to the final price tag.
Right, and with this acquisition, their stick is now worth an estimated $4.3 billion.
Okay, so $3.5 million turns into $4.3 billion. That's a return of over, I'm going to do the math, 1,200%.
It's mind-boggling, isn't it?
Absolutely. It makes you want to go out and find the next whiz.
It really does, but it's important to remember that these kinds of wins are rare, incredibly rare.
Right. For every whiz, there are probably 100 startups that just fizzle out.
Oh, yeah, definitely. But the Wall Street Journal, they share this great anecdote about Shardul Shah. He's from Index Ventures, and he got the call about the Wiz deal from the founder, Asaf Rappaport. And get this, it was on his birthday back in January 2020.
Talk about a birthday present.
The best kind, right?
No kidding. So this Shah guy, he must have been pretty excited to get in on this deal.
Oh, yeah. Apparently, he'd been wanting to back Rappaport for years. He was impressed with his previous fitters.
So he saw something special in this founder.
Definitely, and it paid off big time.
So Index Ventures, they became Wiz's biggest outside shareholder. They ended up with a 13% stake, and they were in on every single funding round.
From the seed round all the way to the exit.
That's some serious conviction.
It really is. They believed in Rappaport and his vision for Wiz from the very beginning.
And that kind of support from early investors, it can make a huge difference for a startup.
Oh, absolutely. It's like a vote of confidence, a signal to other investors that this company is worth backing.
So tell me more about Wiz. What do they actually do?
Well, they started out focusing on network security, but then they made a really smart pivot. They shifted to cloud security.
Ah, so they're riding the cloud wave.
They developed software that scans cloud platforms for security vulnerabilities.
So like Microsoft Azure, Amazon Web Services, all those big names.
Exactly. And they landed some big clients, too. Barclays, Mars, those are not small fish.
Makes sense. So basically, they help companies secure their data in the cloud, which is more important than ever these days.
Huge market and growing rapidly.
So this acquisition makes a lot of sense for Google. They get to beef up their cybersecurity offerings and tap into this booming market.
It's a strategic move for sure. And the Wall Street Journal, they point out that the IPO market is kind of dreary right now. A lot of startups are choosing to stay private for longer.
Yeah, going public isn't the guaranteed success story it used to be.
So in that context, this huge acquisition of Wiz, it's even more significant. It provides a big fat exit for those early investors like Index Ventures.
Right. In a market where IPOs are less certain and less rewarding, these big acquisitions are a lifeline for the VC world.
Absolutely keeps the money flowing,
Well, there's a catch, right?
There always is. The Wall Street Journal reminds us that the deals still need regulatory approval, and the current administration, they're taking a much tougher stance on mergers, so it might not be smooth sailing.
Ah, so there's still some uncertainty there.
There's always something.
Okay, before we move on from this Wiz story, there's this one detail that really stood out to me. The Wall Street Journal mentions that Rappaport, he actually had another startup before Wiz called Adallom, and that was sold to Microsoft for $320 million.
Yeah, not a bad payday at all.
No, but it's peanuts compared to the Wiz deal, right?
True, but the point is that Shardul Shah from Index Ventures, he saw even greater potential in Rappaport after that first exit.
So it's not just about the idea, it's about the founder.
Exactly. Betting on the founder's talent and vision that can be just as important as the initial business idea itself.
I think that's a good takeaway for any aspiring entrepreneurs out there. It's not just about it's about the who.
Words of wisdom. Let's shift gears again, shall we? This time to a more macro view.
Okay, let's talk big picture.
This MarketWatch article, FedEx is the latest company to sound the alarm on the U.S. economy that caught my eye.
Not exactly the most cheerful headline.
No, not really. FedEx has cut its profit outlook for the third quarter in a row.
3 quarters in a row, that's definitely a trend.
It is, and when a bellwether company like FedEx starts revising their forecasts, downward economists and investors tend to take notice.
Like a canary in the coal mine.
Exactly. So what's FedEx saying?
Well, they're blaming this revised outlook on, quote, continued weakness and uncertainty in the U.S. industrial economy, end quote.
Not a good sign.
No, not really. And they're seeing this weakness, particularly in their business-to-business shipping volumes. Those are usually their higher margin shipments.
Right, and they're also seeing weakness in their freight business. The number of shipments is down, and the average weight of each shipment is down too.
So businesses are shipping less stuff, and the stuff they are shipping is lighter.
Exactly, and that could mean a slowdown in production and overall demand.
It's like a ripple effect throughout the economy.
MarketWatch reports that FedEx's CEO Raj Subramaniam, he specifically called out the freight division during their earnings call. He said they're seeing a pretty significant slowdown there.
Not what you want to hear from a company that's basically the backbone of the economy.
And now FedEx, they're forecasting flat to slightly down revenue for the entire fiscal year 2025. That's a step down from their previous forecast.
So they're less optimistic about the near future.
And they've also lowered their profit expectations for the year to a range of $18 to $18.60 per share. So not just lower sales, but also lower profitability on those sales.
Ouch, that's a double whammy.
And it gets worse. MarketWatch says FedEx is planning to cut back on capital spending this year, which usually means they're getting defensive.
Battening down the hatches.
Exactly. They're planning to invest $4.9 billion down from $5.2 billion, and they're focusing on optimizing their network and improving efficiency.
So basically trying to do more with less.
Right. It suggests they're preparing for tough times ahead rather than investing heavily in growth initiatives.
A cautious approach.
Definitely. Now, their third quarter earnings report, that was a bit of a mixed bag. Their earnings per share were slightly below what analysts were expecting, but their overall revenue actually beat the forecast.
So they brought in more business than expected, but maybe had trouble turning that revenue into profit.
Yeah, that seems to be the case, and MarketWatch highlights all the challenges they've been facing: a compressed peak shipping season, and then those severe weather events across the country. All of that puts pressure on profits.
Yeah, those external factors can really throw a wrench in things.
And remember, earlier this year, there was a lot of optimism surrounding FedEx because of the policies coming out of the Trump administration, but now there's more anxiety about a potential recession, and FedEx's outlook seems to be aligning more with those concerns.
Yeah, it's a pretty clear signal from a company that has its finger on the pulse of the economy.
Okay, let's move on to a brighter spot.
I'm ready for some good news.
This Bloomberg article, Market Strategists Finally Upgrade Europe After Years of Caution, that caught my attention.
Europe? That's been kind of the unloved region for a while, hasn't it?
It has, but this article suggests that things might be changing.
Okay, tell me more.
Well, for years, market strategists have been pretty cautious about Europe. They've favored the U.S. market, but this Bloomberg survey, it shows a big shift in sentiment. Almost half of the strategists, they've actually raised their forecast for the Stoxx Europe 600 index just since last month.
Wow, that's a pretty dramatic change.
It is, and the median target price for the index has also gone up significantly, over 6% to 566.
So they're not just slightly more optimistic, they're significantly more optimistic.
And less than a third of them are expecting a pullback in European stocks for the rest of the year.
That's a big change from the usual doom and gloom we hear about Europe.
So what's behind this newfound optimism?
Well, there are a few factors at play. Bloomberg mentions a big spending package that was recently approved in Germany. It's going to allocate a ton of money to defense and infrastructure after years of tight budgets.
So a big fiscal stimulus.
Exactly. And there's also anticipation of more stimulus measures coming from the European Union as a whole.
So governments are opening up their wallets.
And it's not just fiscal policy. The European Central Bank, they're expected to cut interest rates at least 2 more times this year.
And that would keep their key interest rate well below the U.S. Federal Reserve's rate.
Making it cheaper to borrow money in Europe and potentially making European stocks more attractive compared to U.S. stocks.
Plus, there's growing hope that the war in Ukraine might de-escalate or even come to an end, which would reduce a lot of the geopolitical uncertainty in the region.
That would be a huge relief for everyone.
Absolutely. And Bloomberg, they quote this Citigroup strategist, Bita Manthi. She says, quote, "Seismic policy shifts in Europe could eventually increase the region's long-term earnings per share growth trajectory," end quote.
So she's bullish on the long-term potential.
Very bullish. She actually predicted the rally in European stocks earlier this year. And while she admits that her previous targets don't offer as much upside anymore, she's still positive overall.
She's sticking to her gun.
Another UBS strategist, Jerry Fowler, he thinks European economic growth could accelerate in the coming years, and that could draw money away from the US and into Europe.
A potential shift in global investment flows.
Now, of course, not everyone is convinced. Bloomberg does mention that some strategists, like those at Bank of America, they're still cautious. They're worried about the global economic slowdown and how they could impact Europe.
Yeah, even with all the positive developments, you can't ignore the global headwinds.
But here's the thing. Bank of America's own fund manager survey, it shows a record rotation out of U.S. equities and into European equities.
So some investors are putting their money where their mouth is.
They're betting on Europe.
Interesting. And Frederick Dudod from State Street Global Advisors, he adds to the optimism. He points to those healthier balance sheets of European companies.
And more attractive valuations compared to other regions, even after the recent rally.
Plus a more stable political outlook with less uncertainty in key countries like France and Germany.
It's a confluence of positive factors: fiscal stimulus, monetary easing, improving geopolitical conditions, and attractive valuations.
Seems like Europe might finally be having its moment in the sun.
Let's see if it lasts. Okay, let's turn our attention back to the tech sector. There's some exciting news for a major chip maker.
All right, I'm always up for some tech talk.
This MarketWatch article, Micron gets boost with surging AI memory chip sales, shares rise on earnings beat. That caught my eye.
AI chips, that's the hot topic these days.
It really is, and Micron's earnings, they show just how much the AI boom is benefiting some companies.
So what kind of boost are we talking about?
Well, their fiscal second quarter earnings, they got a big lift from the demand for memory chips that are used in AI data centers.
Data centers, those are the powerhouses behind all this AI magic.
Exactly, and Micron's sales of high bandwidth memory chips, or HBM chips, those actually topped $1 billion for the quarter.
$1 billion, that's a lot of chips.
It did, and the growth rate is impressive too. Their HBM chip sales were up 50% compared to the previous quarter.
50%, that's huge.
It is, and it even exceeded their own internal forecasts, so the demand is even stronger than they anticipated.
The AI gold rush is on.
MarketWatch quotes Micron's CEO, Sanjay Mehrotra. He says, quote, "Micron is in the best competitive position in its history," end quote.
Bold statement.
It is, but their financials seem to back it up. Their overall revenue and earnings for the quarter, they both beat Wall Street expectations.
So they're not just talking the talk, they're walking the walk.
Exactly, and their outlook for the next quarter is also more optimistic than what analysts were expecting. So this strong performance, it's not just a one-time thing.
So what's driving this surge in demand for their HBM chips?
It's all about the need for processing power in those data centers that are training and running those increasingly complex AI models.
More power, more memory.
Exactly, and HBM chips, they offer much higher bandwidth and they consume less power compared to traditional memory.
Ah, so they're more efficient and they can handle those massive amounts of data that AI needs.
And it looks like this trend is here to stay. MarketWatch says Micron has already sold out its HBM chip production for all of 2025, and they're projecting multi-billion-dollar revenue from these chips in fiscal year 2025, with strong demand continuing into 2026.
So they've got a nice long backlog.
A very nice backlog. It shows they've got a competitive edge in this specialized part of the memory chip market. And the demand for AI memory, it's not going away anytime soon.
AI is only going to get bigger.
Mehrotra, he also talked about the PC market. He said they're expecting modest growth there, single-digit percentage growth, but the rise of AI-powered PCs, those are going to need a lot more memory than traditional PCs. So that could provide another boost to their business.
Makes sense. AI is going to touch every part of the tech world eventually.
All right, let's switch gears one more time to the retail sector, where a giant is trying to reinvent itself.
Okay, who are we talking about?
Nike.
The swoosh.
This MarketWatch article, Nike says focus on athletes is paying off, but warns the toughest stretch of its turnaround is ahead that tells the story.
So they're in the middle of a major overhaul.
They call it their Win Now turnaround plan, and they think their focus on athletes is starting to show results, but they're also warning investors that the hardest part is yet to come.
Transparency is always good.
Definitely, and that caution, it's reflected in their sales outlook for the current quarter.
How so?
They're expecting sales to drop in the mid-teens range, which is much worse than what Wall Street analysts were predicting.
Ouch, that's going to hurt.
Their stock took a hit in after-hours trading when they announced that.
Investors don't like surprises, especially negative ones.
So why the gloomy outlook?
Well, there are a few factors: new tariffs, geopolitical uncertainty, a tougher foreign exchange environment.
The usual suspects.
But the main reason for the expected sales drop is their decision to slash their inventory of older lifestyle sneakers.
Like the Air Force One, the Dunk, the Air Jordan 1, all those classic styles.
So they're clearing out the old to make way for the new.
Exactly. They want to make room for new product innovation, and they want to create a more premium experience in their stores and online.
So basically, they're trying to elevate the brand.
It's a short-term hit to sales, but they're hoping it'll lead to long-term growth.
A bit of a gamble, but it could pay off.
Their CFO, Matthew Friend, he said it could take months to clear out all that old
A
inventory.
lot of sneakers to move.
But their new CEO, Elliot Hill, he stressed that even though they're focusing on athletes, they're not abandoning their streetwear fans completely.
They need to find that balance.
It's a delicate dance.
Now, their third quarter sales, those were actually better than expected, even though they were down 9% year over year.
And their training and running shows, those were big sellers.
So there's some bright spots.
And their earnings per share for the quarter, those also beat Wall Street estimates.
Beating expectations is always good news.
Shiraz Mian from Zacks Investment Research, he said in the article that these results were, quote, simply better than many of us feared, end quote. But he also pointed out that they're still facing challenges with their wholesale partners, and they need more impactful product innovation to keep growing.
So they're not out of the woods yet.
Not by a long shot, but they're making moves. MarketWatch mentions that they've partnered with Kim Kardashian's Skims brand to launch a new line of fitness apparel targeting women.
Interesting. So they're expanding their reach.
Trying to attract new customers and keep things fresh.
It's all about staying ahead of the curve in retail.
Let's take a step back now and look at the bigger picture, this MarketWatch opinion piece. Opinion, odds are good that the stock market has finally bottomed out. Here's why. That's a much-needed dose of optimism.
After all that news about economic weakness and recessions, I'm ready for some good news.
Me too. So this author, they lay out 4 reasons why they think the stock market might have hit its low point.
Okay, I'm listening.
First, they argue that the U.S. economy is not headed for a recession, at least not in the near future.
A contrarian view for sure.
They cite several big-name economists to support this view. Jan Hatzius from Goldman Sachs, he thinks worries about an economic slowdown are overblown, and he points to those strong employment figures.
Jobs are still strong. That's a good sign.
But Hatzius, he does acknowledge that those potential tariffs, those are still a risk factor.
Yeah, those trade wars, they can really mess things up.
The article also mentions economists at Bank of America. They point to the strong job market and the fact that income growth is outpacing inflation.
So people are still making more money, and that's good for the economy.
2 other economists, Jim Paulson and Enyer Denny, they're also not predicting a recession right now, although they are acknowledging some of those softer economic data points.
So cautious optimism?
Exactly. The second reason for a potential market bottom is that while consumer sentiment surveys, those have been showing a decline, actual consumer spending hasn't really dropped off.
Interesting. So people are saying they're worried, but they're still spending money.
That's what the data shows. The author mentions this Bank of America retail sector conference where Walmart executives, they said they haven't seen big changes in consumer behavior.
So the pessimism hasn't translated into less spending.
Not yet, at least, and that's a good sign for the economy and the market.
If consumers keep spending, that could prevent a deeper recession.
The third reason for a potential bottom is that corporate insiders, they've started buying their own company's stock again.
That's always a good sign.
It is. It means that the people who know the most about a company, they think the stock is undervalued.
They're putting their money where their mouth is.
And this buying, it's been especially strong in those cyclical sectors like energy technology, banking, industrials.
Those sectors that are sensitive to the economic cycle.
The article mentions a buy signal from Vickers Insider Weekly. They track insider buying, and they're seeing a lot of activity in energy material and consumer discretionary.
Sounds like the smart money's betting on a rebound.
And the fourth reason for a bottom is the current pessimism among investors.
Ah, the old buy when there's blood in the street strategy.
Exactly. When everyone is negative, that's often a good time to buy.
A contrarian approach.
The article mentions that the investors' intelligence bull-bear ratio has fallen below 1.0, which is a strong buy signal, according to this view.
More bears than bulls. That's usually a sign that things are about to turn around.
And the American Association of Individual Investors, their survey has also been showing a lot of bearish sentiment for weeks now.
So everyone's already negative.
Which means there's less selling pressure, and any good news could trigger a rally.
It's all about sentiment.
The opinion piece even highlights 3 specific companies where there's been a lot of insider buying: Wynn Resorts, Victoria's Secret, and MSCI.
Okay, let's break those down.
Wynn, they've got big expansion plans, and the author thinks their stock is undervalued. Victoria's Secret, they had some weak guidance, but their sales are actually growing, and there's been a lot of insider buying there.
Interesting. So maybe the market is overreacting to the bad news?
And MSCI, their CEO, bought a bunch of shares, which suggests he thinks the stock has been oversold.
So 3 potential buying opportunities, according to this author.
Now remember, these are just opinions, and past performance doesn't guarantee future results, but it's an interesting perspective.
It gives us some food for thought.
Okay, let's wrap things up with a quick look at the world of crypto.
My favorite topic.
We've got some interesting developments with Solana ETFs and MicroStrategy's Bitcoin strategy.
Okay, let's start with Solana.
Bloomberg reports that Solana ETFs are coming to Wall Street and lead its crypto push.
ETFs, that's a big step for Solana.
It is Volatility Shares LLC. They're launching the first ETFs that track Solana futures contracts.
So not spot ETFs yet, but futures ETFs.
Right. They'll have two funds with different investment objectives and different expense ratios.
And this is coming right after the success of those Bitcoin futures and spot Bitcoin ETFs.
Exactly. And Bloomberg suggests that these Solana futures ETFs, they could pave the way for approval of spot Solana ETFs maybe even later this year.
That would be huge for Solana.
Bloomberg intelligence analysts, they're giving it a 75% chance of approval this year.
Not bad odds.
Now, here's an interesting tidbit. While Ether futures ETFs already exist, the spot Ether ETFs, those have actually seen outflows recently.
So investors are pulling money out of those?
It seems like crypto investors, they prefer holding the actual digital asset rather than going through a spot ETF.
Yeah, they like having that direct control over their crypto.
Solana, by the way, it's had a pretty impressive comeback after that whole FTX collapse.
FTX, that was a tough time for a lot of crypto projects.
It was, but Solana, they've bounced back. Their lower transaction fees, those have helped a lot.
Makes them more attractive to users.
And Bloomberg highlights the fact that Solana, it's been seen as the most likely vault coin to get ETF approval, mainly because of all the institutional investor interest it's been attracting.
Institutions, they're the big players.
And their interest is driving the development of these more regulated and accessible crypto products.
It's all about bringing crypto into the mainstream.
Okay, let's talk MicroStrategy.
The Bitcoin king.
Bloomberg has this article, MicroStrategy's Bitcoin Gambit takes new form with perpetual stock.
Perpetual stock now, that's intriguing.
It is Michael Saylor's company. They're planning to sell this new type of security they're calling Perpetual Strife Preferred Stock.
Catchy name.
It'll have a 10% dividend yield, which is pretty attractive these days, but it won't be convertible into common shares, and it's meant to trade forever, hence the perpetual part.
So it's like a bond that never matures.
Exactly, and this is different from how they used to raise capital. They often issued convertible debt.
So they're trying something new.
They've raised over $10 billion in the past year, and they're planning to raise another $42 billion in the next few years, all to buy more Bitcoin.
They're all in on Bitcoin.
They currently hold about $42 billion worth of Bitcoin, so this is clearly their core strategy.
And who are they targeting with these new securities?
Well, they're convertible debt that mainly appealed to hedge funds who are looking to profit from the stock's volatility, but these new securities, they're being marketed to investors who are more into trading debt instruments, could be retail investors too, similar to their existing preferred stock units that trade under the ticker STRK.
So they're broadening their investor base.
It's an evolution of their Bitcoin strategy.
Innovation never stops in the crypto world.
So that wraps up our deep dive into this week's Financial Magazine headlines. We've covered a lot of ground.
We certainly have, from bank debt to tech acquisitions to economic outlooks to European stocks to AI chips to retail turnarounds to bullish market predictions to crypto ETFs and perpetual Bitcoin stock.
It's been a whirlwind.
A roller coaster of financial news.
But hopefully we've given you a good understanding of what's been happening in the markets this week.
And some insights to help you make sense of it all.
Exactly. We'll see you all Monday morning with new headlines from major financial magazines.